This installment of Module 2 looks at some more advanced or miscellaneous topics in investment accounting and applies to both debt and equity investments. And so we're going to see a mix of both types of investments discussed on these pages. The first item I wanted to talk about or address is shifting classifications. Now, on purchase, we do have an initial classification. However, that is not a permanent. If managerial intent were to change and they can convince the auditor that the change was not just in the spirit of manipulating net income or earnings or some sort of non-substantive reason, then they are allowed to change and switch. Of course, as we've discussed in class, the tainting provisions could still apply to held to maturity securities if there is not a unique or extraordinary event that causes them to want to reclassify a lot of these securities. In terms of what we do, remember for all of these, we need to update the carrying value and update the market value for AFS and TS only, of course, on day of shift. So again, sort of like selling one of these investments off or selling a fixed asset off, we always want to update their accounting values on the day of this decision making. And I do include it in some of the descriptions, and I notice that I don't include it in all. But just know that this is a universal rule for any transition, is that we need to update the carrying value in the case of all debt investments. We need to update the market value in the case of trading securities and AFS securities. So when we look at reclassification, the first one talks about reclassifying from HTM or AFS to the trading security designation. And the procedure here is to recognize the entire unrealized gain or loss position as if it happened in this period, as if it all happened in this period. So in the case of AFS, there could have been 5 years of gains and losses that we're now reclassifying as one unrealized gain or loss into trading securities in this period. In the case of HTM, there would be no unrealized gain or loss recognized up to that point, but all of it we would recognize in this period. So when we're going from HTM, we would of course mark the carrying value to market on the day of the shift, and then assess after that, after we have that updated CV, we would do the usual item where we would just say, okay, well, what do I have to do to transition from the carrying value to the fair value? Well, whatever that amount is to transition, that is going to be the balance of my security fair value adjustment account, right? If it's a loss position, we put it in the credit. If it's a gain position, we put it in the debit balance. Now, if this is an AFS security, of course, again, we update the market value, we update the mark to market. And then to shift, we would just reverse whatever the total unrealized loss was and put it into an unrealized loss for this period. And you could do it two ways. You could either credit, the easier way, honestly, is just to, if, for example, we had an unrealized loss in our AFS security up to that point in time, I would credit the unrealized loss. Oops, jumped ahead of myself. I would credit the unrealized loss to the OCI account, and then whatever that amount was, I would debit the unrealized loss appropriately to net income for that period. And so we're just reversing the one loss by crediting it, backing it out, if you will, and then debiting the unrealized loss to net income. So that will eventually, when we close this unrealized loss out, that will reverse all the effects this AFS security has had to accumulated other comprehensive income, and this will set the current net income to the correct value. When we're going from the opposite direction of what we did here, we're going from a trading security designation to either HTM or AFS. For both situations, we want to, again, market to market, update the carrying value up to the day of shift. And at that point, of course, recognize all of that into net income that we need to. So everything, obviously the interest revenue, but from the mark to market shift, we want to recognize all of the unrealized gain or loss up to the day of reclassification in net income because it was a trading security up to that shift. And then we'll either recognize future gains and losses through OCI if we take the AFS designation, or we'll just simply ignore them if we take the HTM designation. When we go from HTM to AFS, again, market to market, mark the carrying value, everything up, then the total unrealized gain or loss will flow through OCI. So it's very similar to converting from HTM to trading securities. Here, again, we're just going to take that carrying value, push it over to its fair value, and then whether it be a gain or loss, we record it accordingly in the security fair value adjustment account as the balance of that account with the other AFS instruments that we have. If we're going to AFS to HTM, this one's a little different because if we're going from AFS to HTM, we have an unrealized gain or loss, right? When we did trading securities to HTM, it was a little easier simply because those unrealized gain or losses are flowing through net income. They're being realized. However, since AFS is not realized, it's not going through net income, we're going to have this this stagnant amount, if you will, this unrealized gain or loss in AOCI that represents the unrealized gain or loss position in the AFS security. So, of course, we market to market, market carrying value to market, but for the total unrealized gain or loss, and that's not just for this period, but for all periods the AFS security was held. And so remember that means that there is a portion, everything prior to the current period, what we're going to do then is slowly amortize that portion of unrealized gain or loss to net income over the time until the security matures. So say there's 5 years left, then we break up that total unrealized gain or loss and then recognize it over 5 years, putting it into net income over those 5 years. For the equity method, we could, for example, sell some shares and then all of a sudden not have over 21% ownership in the company. We could do this deliberately. I would hope we don't do it incidentally because that would be a big surprise. However, some will deliberately sell out of their equity method investment. Then the procedure there is to discontinue the equity treatment, use that balance in the investment account as a cost basis. So it's just like we had purchased that much of the fair value. And a slight update, of course, because we can no longer use that. I forgot to update that. That's no longer an allowed treatment. So the OCI for AFS doesn't work anymore either. But so whatever the balance in my investment account is, my equity, I'll call it my equity method investment account, whatever this account balance is, we take that and then we mark it to market. And whatever that amount that we mark to market, as usual, is the balance for my security fair value adjustment account that I would want to update. Either it's going to be a gain or a loss, and I would want to record the appropriate balance for that gain or loss. With the AFS, with the trading security, the trading securities to the equity method, this used to have a very different rule that was recently updated. And what the rule is now, well, it used to be that we had to retrospectively, if we switched from trading securities, we bought enough securities that we now had more than 20% ownership, we would have to go back and record how we would have marked this under the equity method. It's a retroactive treatment where we go back all the way to the purchase of these items and then mark it by the net income of the company, bringing the investment up or down. We've greatly simplified it with this change. We just use the fair market value of the trading security as the cost basis. So it's as if whatever the fair market value of that security is on the day of the shift, that's the amount that we purchased this investment at. And then apply equity method accounting. So then after this point, we just examine the net income of the parent, of the investee, and apply the pro rata amount of net income to this value, and then record it through equity method accounting, where we debit the investment and credit investment revenue. Right? So this is kind of, to me, the icing on the cake, if you will. So if you are understanding all of the underlying mechanics and procedures and the classification implications of these instruments, these almost start to fall out just by way of logic. And that's kind of, to me, the goal, is that if you can get to this point where these are just falling out because they make sense, you're very conversant, right? You're switching from the language of AFS to trading securities, from trading securities to HTM, from equity method to trading securities, etc. So I think this is a nice kind of crowning achievement. That being said, if you're still having issues with just the basic mechanics of these, this is going to be rather intimidating. So maybe tuck this away until you have better practice with the basics, and then come back to it later to see if it kind of makes it all fit together. Right? So let's look at a couple of examples. In a problem, I would try not to put too many working pieces on a test question with these. So I wouldn't make you calculate the present value, do an interest to revenue amortization, and all this kind of stuff. I would more so give you the facts of the problem, that kind of the results of all those calculations, and then have you calculate the consequences of the shift. So as a for example of how I might simplify that, I have Furiosa reclassified certain investments in its HTM securities portfolio during 2017. The company is considering the financial ramifications of reclassifying these securities as AFS versus trading. So we're going from HTM is their current designation, and now we have a quandary that management is trying to figure out. Well, what happens if I switch it to AFS? What happens if I switch it to trading securities? And I misspoke. If the intention, to some degree, and not, they couldn't do it rapidly, but it's more acceptable to first reclassify HTM and then sell them than it is just to sell them outright. Now, it's still very difficult to get someone to sign off on that. And if you did it too much, I'm not 100% sure that would trigger the tainting provisions, but I'm pretty sure it does. I don't quote me on that. I haven't researched it. I know selling out of HTM triggers tainting provisions. I'm not 100% sure if moving with a stated intention prior to that raises red flags, as does just selling outright. But that's something I'll investigate. Anyway, so if we're moving from HTM to AFS or trading security, and we want to know the potential ramifications of that, so the company is doing that, and suppose the face value of the securities was $2 million with an overall discount associated with the securities of $357,000. We'll assume that this is the discount as of the day of the shift, because remember, we always need to update that. That carrying value. If the current market conditions value the securities at $1,820,000, so this is my fair market value on the day of the shift, Then it asks me to determine, well, what is the effect on net income if I reclassify as AFS or trading, the effect on comprehensive for those two designations. So if that's the day of the shift, then we just need to figure out the carrying value, which I give you pretty easily as the face value, $2 million, minus the overall discount present at that date, which gives me a carrying value of $1,643,000. And I'm going to mark that up to $1,820,000 because that's the fair value. So this is the carrying values of that day. This is the fair market values of that day. Remember, the adjustment on that day is what we want to put into the security fair value adjustment account. And so I didn't really leave myself room there. Let me come over here in the margin and just kind of show you exactly, because you can't show this balance thing enough for students. The difference between those two is a positive $177,000. That becomes my debit balance because it is a gain position. And again, that's my balance. Please don't screw that up. The adjustment from carrying value to fair market value, the adjustment of any of these investments to their fair market value is the balance of this account. Now, just for simplicity's sake, let's assume that there's no other AFS or trading securities such that this balance represents the only security. Now, the journal entry to record that then becomes quite simply, remember, the adjustment that I would have to make to market. So in this case, I'd have to adjust it. And again, I do it in a different colored pen just to show you that this adjustment corresponds to the journal entry I would record down here, a debit to the security fair value adjustment account. And for 177, and an unrealized gain of 177. Now, where that gain goes, of course, is related to whether this is going to be a security that is available for sale or for a trading security. If it's available for sale, then we're going to notice that gain in comprehensive income. If it is a trading security, it's going to go into net income with no effects to the other category for this particular instrument. All right, now I have the same effects as above, but let's now assume that it was an AFS investment, and they want to see, well, what will happen if we reclassify it as HTM? So we're going from AFS to HTM, that kind of cool and unusual one I talked about, where you have to amortize the difference of the unrealized gain or loss into, into the net income over time. So if the same facts had been as above, then we would have the carrying value to fair value at that day of shift give me a balance of $177,000. That is the overall, doesn't matter even where I came from. Doesn't matter what balance I might have had. I could have had any balance here. So I'll just call it X because it could have been anything. And still, this is the total unrealized gain or loss that I would find in AOCI because this is AFS. So the total unrealized gain or loss I would find in AOCI. So how would this affect these two items? The idea is, again, we are going to slowly reclassify these guys. If there was 5 years remaining until the security matures, it has 5 years to spend as an HTM security. That means we're going to break this thing up over 5 years. And that's going to give me $35,400. I'm going to recognize each of those 5 years. Now, this is an overall gain position. So that means it's going to positively affect net income for each year that we amortize it. We'll assume a full year effect in the first year. And it'll also have an effect on comprehensive income because we want this thing to be slowly, remember the term I said they use is recycled into net income. And so it have this equal and opposite effect on my comprehensive income as I'm reclassifying, recycling this unrealized gain or loss position into net income. So, something worthy to take away, like I said, I want you to kind of think about what these things represent. For an AFS security, these balances reflect the unrealized gain or loss held in AOCI. All right. So just something to think about. For trading securities, it's a little different because then it's reflecting what is currently in retained earnings, right? But this is for AFS securities. This reflects the AOCI total balance. And then remember, any adjustments we make in this account over time, those reflect the effect to OCI for the period. So again, we're getting into that idea that the adjustments are the journal entries, the changes, the things that go to income because they're just a change over time, versus the balance, the stockpile goes to my real accounts, that's on the balance sheet, right? The final piece that I want to talk about in this module is just there's hot off the press sort of stuff. IFRS recently finally revamped their investment security standard. IFRS 9 is now the governing standard for their classifications. It was IFRS or IAS is what they call them, International Accounting Standard, right? Number 39, so now it's 9. And there's some interesting differences. There's, of course, just nomenclature, whereas we call them trading, IFRS calls them fair value through net income, just much more on the nose with their terminology. Available for sale securities are fair value through other comprehensive income. So a layperson who might, they might not know what OCI is, but hey, they know, oh, well, I get a fair value, and I get that fair value by marking through other comprehensive income. Held to maturity securities, amortized cost is what IFRS calls them. So that's just the sort of superficial differences. There are a few differences other than the ones I mentioned. I'm just going to highlight the primary ones that I thought were of most interest. To me, the most significant difference is how they classify debt securities. Under US GAAP, there is a managerial intent, right? So all we have to say is, does management intend on holding them to the maturity? Does the management intend on selling them? And if it doesn't go to one of those extremes, AFS is what we would deem the default or the catch-all. So, AFS isn't really, it's the sort of none of the above classification. I don't intend on holding it. I don't intend on selling it. Therefore, it just falls into a gray area, an ambiguous classification, if you will. In contrast to that, IFRS applies specific tests for HTM and AFS, and their fair value through net income, their trading security, becomes the default category, which is interesting, right? Because most things are going to fall in the default. Most securities, most debt investments are classified as AFS. Whereas if you have stringent tests for HTM and AFS classifications, that probably means your trading security or fair value through net income is going to become the most populated category of investments. So that could have some repercussions to the volatility of net income for international companies or for companies using IFRS. vis-a-vis US GAAP. So there could be additional volatility in this. It's pretty recent, so we haven't really seen the full effects of this reporting standard, but I'm sure there'll be some empirical work coming out pretty soon that looks at that. The two tests that IFRS applies, it's not about managerial intent. They kind of take that soft, subjective criteria out of the loop. Instead, they apply a model test and an SPPI test. And this is something that auditors will have to look at when examining whether management made the appropriate classifications. For the model test, it says that the primary model of the business must be to hold investments to obtain cash flows, contractual cash flows, or to hold investments to obtain contractual cash flows, as well as selling financial assets. So in order to classify as HTM, you have to prove that you have a track record of holding investments to obtain contractual cash flows. Now, that doesn't necessarily mean that, as far as I can tell, and I was really looking for some sort of definitive guidance there, I just didn't find it. But that doesn't mean it has to be an investment bank or a bank. It just means that if the company's investing in debt investments, that they are holding them, they have a track record of doing so, or that they have a track record of doing a little bit of both. And that would, again, vary from type of investment to type of investment. Maybe there's certain investments that they do hold for their contractual cash flows. Maybe there's other investments that they do a little of both with. And so this becomes a much more stylized test of historical patterns of how the business handles its investment portfolios. So that's more onerous than, oh, I intend on holding it or I intend on selling it. Then the SPPI test is that with this particular asset, the contractual cash flows have to be solely from payments of principal and interest, solely from payments of principal and interest, which means that, for example, there can't be an option on these guys under which you could receive a cash flow. So that gets into some underlying issues that might occur with derivatives and things of that nature, where they might have alternate contractual cash flows that underlie the instrument or the investment. For equity securities, IFRS, the big difference is IFRS is still allowing the available for sale classification, but it makes it irrevocable, barring some extraordinary, unique circumstance where you would have to sell them off for macroeconomic pressure, crisis, liquidity, huge, like market-wide liquidity, not just company liquidity. So it makes it a pretty stringent classification, and then also does not recycle, quote, you write that term, unrealized gains or losses on the sale of AFS through net income. So, we talked about maybe the manager's ability to influence earnings by selectively selling available for sale securities and then recognizing those gains or losses through net income. IFRS just bypasses that earnings manipulation issue by having all of those realizations just flow through available for sale directly to equity. So it would just go straight to retained earnings. It wouldn't affect net income. So that's their way, I believe, of handling the managerial the earnings management aspect of security classification. So the final piece, the final video I will create will be impairment of debt investments, equity investments. More so debt investments is what really, there's typically not an impairment of equity investments. So we're going to look at the impairment of debt investments, when it occurs, and how that effect can trigger to both net income and other comprehensive income. Thank you very much for watching. Hope you learned something.